Tarun Kataria, independent market analyst, who joins us live in our Mumbai studio. Tarun, fantastic to have you back. Thank you for joining us. It's been a one-way street, Tarun, for Indian markets. Do you think in the short term this is as good as it gets, or we are in a liquidity-infused environment and it will be a while before we top out?
I think there are two parts to your question. One, I think liquidity continues to stay. I think the talk overnight that sort of tapering is now, December again, I don't think plays out at all. I don't think anywhere in the Fed speak there's been a discussion about sort of GDP growth, being the trigger to start a tapering program. There was a target of inflation of, I think, about 2%. We're still at 1.2, so we're 80 bips away on the inflation number. The employment number, I think we're still about 100 basis points away. And actually, if you look at, it's taken about 2 years to get from 8.5 to 7.5% employment, right? And you know that the next 100 basis points actually gets harder. So get to a target of 6.5 is some ways away. So I think tapering is, at the earliest sometime in March, April next year. So I think liquidity stays. I think what you're going into right now is sort of a period where investors start to wind down for the year. So I think, frankly, at the end of November, I think you will see things quieten down even more. So while we've had a heck of a run from, I think the August lows were up almost 18-20%, I think it's time for a pause now. Sort of people will sort of analyze where the rupee is going, and, as that sort of becomes front and center, equity markets take a breather. So yes, you've got liquidity on one side, you've got the year end on the other, and you've got a little bit of pressure on the rupee again, would suggest that we certainly don't go materially higher from here.
Tarun, what's the sense that you're getting about the currency? Because that again has been weakening in the last couple of trading sessions. Unfortunately, it's also been correlating with FII buying slowing a tad bit. Do you think the rupee could weaken to alarming levels yet again and thereby become an irritant for equities?
I think it's entirely possible, right? If you look at the last X number of years, despite everything, the rupee has a general bias to weaken, and it has, spurts of excessive weakening as we saw in September, October, or in August, September. So I think to suggest that there is a strengthening bias to the currency, for the next 12, 18 months, I don't think is right at all. The bias will be to weaken. And you'll have some days where you'll move a rupee, some days you'll move 20 or 30 paisa, either way. But the bias is generally to weaken. And I think we've all learned, right, that India, like every other emerging market, the currency, equity markets is all about FI flows, right? Domestic participation in, as we've seen, retail, people are shutting down retail businesses because there's no domestic participation. The market's entirely driven by the mood of FIs, which is the currency and the equity market. So we will remain sort of at the mercy of how they perceive sort of where we're going with India macro.
Tarun, but do you think it's a matter of time that Indian retail investors will come back into Indian equities because the other asset classes are not making money, gold has lost its shine, fixed income products are not doing well, and with the exception of Mumbai, real estate prices in India also have come down?
If you ask me, you made the comment about fixed income, right? If you're able to get 10 or 12% compounded for the next 10 years in fixed income, actually that's a heck of an asset class. It doesn't need to appreciate materially. At some point it will, but for the moment, if somebody's giving you 10 or 11% compounded for 10 years, it's a tremendous asset class. So I sort of disagree with the view that fixed income has done nothing for you. It's had a sell-off in the last, 2-3 months. But at these levels, fixed income is a very interesting place to be.
Metals, Tarun, have been the big underperformers of 2013, but now, the tide seems to be turning off late, of course, with Chinese data coming out positively. Yesterday, we saw good numbers from ArcelorMittal, which augur well for names like Tata Steel and sort of at least raise hopes in terms of what the European business could deliver for Tata Steel. Anything that you like out of that space?
Well, I think metals, you should be sort of generally on the long side of metals, and I think it's really, if you see what's happening with coal flows out of Australia into China, all would suggest that China, while slow, is at least creeping back into a mode where the infrastructure spend starts to build up again. And if the infra spend in China builds up, coal, steel, all that sort of starts to, develop an upward bias, which I think is what you're seeing now. So metals needs to be part of anybody's portfolio.
Do you think banks have a long way to go before, they could come out of the woods?
See, I think banks, if you sort of look over a 5 or 10 year period, if you're going to play the India story, tremendous way to play the India story is through the private banks. In the near term, and when I say near term, it's possible it's the next 12 to 24 months, you will have a curve that's flat to inverted, which is, not the best thing that you can do to a bank. And you've got to work your way through NPLs. And it's current NPLs and NPLs that will still need to show up because, we're not going to see a massive catalyst up in GDP growth. So banks will be under pressure for the next 12 to 24 months. But again, if you've got a long-term portfolio of equities, some of the smaller private banks ought to be in there. But, I don't really see any material upside from here.
Tarun, like you rightly pointed out that Indian markets currently are dictated and dominated by foreign institutional investors, and foreign investors rarely go down the ladder, they rarely buy into PSU banks or cyclical stocks. But if I look at the price action for the month of September and October, cyclical stocks have done exceptionally well. So I wonder who's buying them.
Well, from the lows, I think pretty much everything's done well, right? So you've got 20% up from your August lows, both the Nifty and the Sensex. So I suspect many things have moved. But if you look at over the last 12 or 18 months, it's really the quality names that have done well. The mid caps have underperformed materially. Now, there's one section of the market that will say these guys have underperformed, let's go chase them, which is fine as a strategy. But my view is, if you stick to the well-run, well-governed, quality names, you're still okay. Mid-caps, you've got to be, there's a lot of questionable names in the mid-cap space.
To pay that price for earning visibility because what is growing is expensive. FMCG is trading at 30 times forward, IT is no longer cheap, TCS is 20 times, Tech Mahindra is something like 17, 18 times. Is it a good idea to pay that premium?
My personal view, absolutely, because, as you saw in the 80s, you sort of have themes over time. In the 80s, when sort of derivatives, for example, was a new asset class, companies that hedged their FX risk, their interest rate risk, traded at a 15-20% premium to their peers. In my view today, for the next 5 or 10 years at least, companies that are well governed, that have strong governance standards, that have strong CSR standards, for example, will trade at a premium to their peers. So there's no reason why, if you're trading at a premium to your peers today because you're well run or well governed, that doesn't change or indeed accelerate over time. So I wouldn't view them trading as a premium, go short. No, actually stay long with them if they're well governed names.
What's the sense that you're getting, Tarun, then about the auto pack? Of course, we are anticipating Tata Motors' earnings today, but so far what we've seen from the monthly sales data as well, there seems to be some revival kicking in.
Yeah, there'll be a little bit of a revival, but I guess, with interest rates where they are, you're going to see a material jump. Maybe there's some seasonality to the general Indian scene. We'll put JLR aside for a minute, but there's no real... when income and jobs are under pressure, when interest rates are high, can you see a massive jump in auto sales? The answer is probably not, right? Now, I don't track them sort of on a daily, monthly basis. From a macro perspective, it's tough to see, that kind of jump.
Tarun, whereas everyone on the street is of the view that liquidity is unpredictable, it is slightly fickle, the only thing which has remained constant for Indian markets in the last 5 years is global liquidity.
Yep.
We've got about $40 billion of flows, and it is now evident that tapering is off the table. So till the time tapering is off the table, flows will be strong. If flows will be